What's going on, Cash Flow Hackers? It's Chris, Life 180. I got Tom Wall. Buddy, what's going on, man?
Great to see you.
You too. So we are at the Better Wealth Life Insurance Summit, and we're here in Nashville, Tennessee. Tom spoke today. I speak tomorrow, but we have a little time here and thought it would be valuable to just kind of sit down, have a conversation. It's been a while since we've done a video, unfortunately. We need to do this more often. But so we're just having a conversation and thought it would be valuable to talk about something that's been coming up a lot for me lately. And Tom is better than anybody I know in the industry when it comes to just breaking this stuff down and making it really simple. And that is, you know, the fact, well, let me give a little backstory. So I was on TikTok and I started talking to all these Primerica agents, right? Like their buy term invested difference. And they're always talking about why their methodology is superior, why buy term and invested difference is superior to utilizing whole life insurance. Even though they believe in a lot of the similar concepts and needing an emergency fund and financial structure and all these different things, but their mindset is the opportunity cost of not being able to invest your money and having it trapped in a whole life insurance policy makes it negligible, or like, you know, the opportunity cost for them is too high when it comes to, obviously, you put your money in a whole life and it's not earning the 8% or 12%, whatever the crazy people think that you're going to be able to earn. Yeah. And so my stance is, I think whole life insurance is one of the most powerful assets in the world, not just because of what it does for us, but because of how flexible it is in the sense of how it will grow for us, grow with us throughout life and solve different problems as we age and as we grow and as our needs change. It's the only asset I know that will kind of evolve and help us solve our short-term needs and our long-term needs that if we don't deal with now, like you and I are 45, right? So it's like, when we're 70, we're going to have needs that if we don't deal with them now, they're going to be wildly more expensive at that point in time. And so we can kind of have our cake and eat it too. And so can you dive in a little bit?
So it makes sense. The concept makes sense. Buy term in the short term, when you don't have a whole lot of assets, you cover the liability, meaning death for your family.
Yeah.
And then the whole idea is you're investing along the way at the same rate that you would invest or contribute to a whole life insurance plans. And then someday you'll have your millions in retirement and you won't need life insurance. It makes sense.
Great.
Like that math actually can work. The way I couch it though is permanent life insurance is not a need, it's a want. Like when you get to retirement and all you have is a volatile bucket of assets sitting in equities, bonds, doesn't matter what it's invested in, it carries risk, then you're going to be terrified to spend those dollars. Like you will be in a position as a multimillionaire potentially terrified to spend your money because you're not going to earn any more money, hypothetically. Whereas if you have permanent life insurance, you have now a guaranteed legacy for the next generation. You have guaranteed cash values. You have money that's outside of the market and the tax system. And the key to it, you get all those advantages without the strings attached.
Yeah.
So, you know, a 401k has strings attached. Your home equity has strings attached.
Sure.
Any other place that you invest with tax advantages has strings attached. There's contribution limits. There's when it has to come out. There's what it can come out for. Whole life has none of that. So I talk about being, it allows you to be opportunistic on the upside during your working years, having that source of capital. I mean, the market's crashing. There's World War III breaking out. You got a source of capital that's rising. You can turn CNBC off. So that's defensive. Offensively though, a great example is, you know, during COVID. Yeah. You know, the pandemic's happening, you know, the market's crashing. Everyone says cities are dead. Home values in major cities are cut in half. Yep. I can tell you, I can't count on two hands the number of people that came to me and said, I took $100,000 loan out of my whole life policy, bought real estate. It's now tripled in value.
Yeah, exactly.
In these cities, but of course came back. So it's not about rate of return. It's not a math problem. It's about where do you want assets allocated? And the way I put it in my talk today was, I think so many people are focused on return on investment, ROI. And the ROI for me is return on income. If I can shift assets and get a similar return, but because that shift allows me to spend more freely, people don't spend portfolios, they spend income. And that's the shift that people need to think about.
True. What do you talk about when it comes to, so one of the things I talk about a lot is, even if it works, even if the math behind the buy term and invested difference works until you hit, like, say 65 at retirement, they don't have a plan. We need to start planning from now till 100, not now till 65, right? And so from an income distribution perspective, as you just kind of like alluded to, having a bucket of assets that is there to protect you and make sure it's a volatility buffer, make sure that On down years, you have access to capital, so you're not spending negatively performing assets. But I talk about it a lot. Have you ever, what is the phrase they used? Because I said this to these Primerica people, right? And they just didn't get it. And they're like, I can do the same thing with less risk. I think, what is it, like buffered ETFs or something of that? Have you ever heard of this? Or and they're like, we could do that with less risk and all this. So why would we do this? Do you have anything to say to that?
It's not guaranteed.
No. Okay.
Any investment that you have is
sure.
It's not guaranteed.
Yeah.
So, you're paying for term insurance.
Mm-hmm.
The way I like to couch it is this: there's this thought process that you are going to do better with investments than you can do with whole life insurance, right?
Yeah.
And they think of life insurance as a cost, but as I said to you recently, whole life is a performing asset.
Yeah.
You will get a rate of return. You will get more cash value than you paid in, generally speaking.
Mm-hmm.
Unless you're wildly unhealthy, that may not be the case, but you
Sure.
get more money back than you paid in while you're alive. Then at death, there's this guaranteed delivery of future dollars, that ultimate gain of life insurance. And if you look at the rate of return on that, if you live for almost forever, it's a very bond-like return, because that's what these insurance companies are invested in. So comparing it to equities, like whole life versus investing in equities, is frankly stupid. Like, it's not the same thing. One has risk,
totally.
One doesn't. One is an insurance policy, one is not. Mm-hmm. And it also ignores the fact that as you get closer to your goals, any prudent investor, no matter how aggressive you are, should have an increasing allocation towards something that's not the stock market.
Totally.
So if Great Depression breaks out again right before you retire, you have other assets to fall back on. So if we know we are going to be building an asset that is not equities,
mm-hmm.
whole life insurance shines in every analysis you could possibly do. And as long as you're staying in that lane, comparing whole life insurance to cash, fixed income, money markets, just the safe stuff, however you define that, then the math is irrefutable. Mm-hmm. As long as you're buying it from one of the big mutual dividend-paying whole life insurance companies. There's a lot of, there may be some other carriers out there that are not great to look at.
Sure.
So as an industry average, I don't know. But if you're looking at the right companies, they've been delivering value at a very high level for centuries.
Right. I always say whole life insurance company do one thing better than any other financial institutions, is get you the best possible rate of return with the least amount of risk possible. Right. And so it's like, when you look at that, it may not be the sexiest thing to look at, but when you take the risk factor into the equation, nobody else is going to do for you what a whole life insurance company is going to do for you.
Mm-hmm.
Right. And so the way I look at it is, it's a way to gamify the system. Right. It's like we're gamifying life, and we're ensuring that we win the game. It's kind of like the Bible is like, all right, we already know who wins, right? Like we've won the game, and so why not just win now? So by putting a whole life insurance policy, you know what the result is going to be, and so in a sense, that's gamifying your life, because now you get to go out and show up so much differently in your life because you know the end result before you even get there.
Exactly right.
Right? I mean, so that's powerful. So you wrote a book. I want to talk about this before, it's like you wrote a book, Permission to Spend. We've talked about this a bunch. It's kind of you've got your PhD in retirement income planning, right? And so we've talked about this before a little bit, obviously, but on previous videos. But talk to me about what the thesis of that book is and how that has evolved because now you're running whole life masterminds. You are teaching high level agents across the industry. Can you talk about how, since you've written the book, your whole philosophy has maybe evolved a little bit?
What's been amazing to me is my philosophy hasn't really evolved at all.
Okay.
These are the most time-tested strategies out there. I wrote the book because I got so convicted in my research around why this stuff makes so much sense.
Yeah.
And the first line of the book says, "You will be afraid to spend." I will repeat that. You will be afraid to spend. And the reason I say that is because you can, imagine for a moment someone writes you a $5 million check and say, here you go, there's a $5 million check. You can sign it and cash it right now. Mm-hmm. The only catch for cashing that check is you can never earn another dollar on this planet ever again for as long as you live. That's effectively the proposition that retirees are facing at retirement, is that they've saved their millions, however many it is for them. And
for most Americans, it's like 500,000, 5 million.
Whatever the number is. Like, they've saved their number.
Yeah.
And now they have to manage that for the rest of their life, which has an unknown endpoint.
Yeah.
So they have to be an investment manager.
Yeah.
And they're just terrified. They're absolutely terrified. So I got fixated on this puzzle. I really think 9 out of 10 advisors in this country are solely focused on accumulation.
Mm-hmm.
And a question I would ask to a client is like, tell me, when you had the conversation about spending down your assets in retirement and where that would come from, how did that conversation with your advisor go? And their response would be like, well, we didn't have that conversation.
That's not what they're doing.
That's how you know you're working with an accumulation advisor. That's where buy term invest the difference works, because the calculator says you'll have a bigger number at the end point. It's not about that, though. If you can get similar overall bucket of money by incorporating whole life insurance, which you should and will, because it should give you that fixed income like return over time.
Sure.
It's simply a different allocation. But because of the guarantees and because of the PEG death benefit and because of potential long-term care benefits, all of those in your portfolio, you are going to be far more free to spend and enjoy everything else, maybe annuitize. And by the way, rates on annuities and guaranteed income, basically turning your investments into a pension, it's about double what you would prudently take out of just a bucket of assets on day one retirement. And that's the puzzle. The puzzle is not, insurance versus investments to get clients wealthier one way or another. It's how do we give them freedom to spend and enjoy that which they've worked 40 years to accumulate. Yeah.
No, I mean, so when you say that for annuities, or like if you annuitize whatever it is, right? Like right now, whatever it is, rates have gone, I guess it depends on how old you are. There's a whole range when it comes to that. But when you say double, I mean, you're comparing that. I'm saying this for everybody watching this that maybe is kind of newer to this space. Comparing it to the 4% rule, right? And
if you think of the 4% rule, basically says if you have a volatile bucket of assets, call it $1 million, you can start taking $40,000 per year, increase it by actual inflation, and it should last at least 30 years based on historical probabilities. That assumes that the next 100 years are the same as the last 100 years. I don't believe that, but
totally.
But that's kind of the math on it. Is like that's a conservative withdrawal rate. Some people say 3%, 3.5%, whatever it is. If a 65-year-old male today could turn $1 million into $75,000 of income, he can't outlive from the highest paying carrier. It's quite literally double what you would get from that safe withdrawal rate, but it's actually safe. It's guaranteed for as long as you live. So why doesn't everyone do that? There's two good reasons. Why doesn't everyone do that? It's called the annuity puzzle from the academics. And one is this perceived loss of liquidity.
Right.
Okay, I'm gonna giving my money to an insurance company who's gonna give it back to me forever. But now I don't have access to that $1 million. Well, guess what? If you have $1 million retirement account and you then invade principal, you've now jeopardized the rest of your existence on the planet.
Totally.
The whole plan is shot. So it's perceived liquidity. But the second more important one is if you live a while, which just about everybody will, then there's no legacy left. Right? That annuity continues to pay as long as you live, but there's nothing left for the next generation. Right. So what if there was an asset you could have in your portfolio that guaranteed your kids are going to get however many millions you want to leave them? You have a bucket of money that you can tap into that's outside of the market, outside of the tax system, fully accessible at any given time, opportunistically or defensively, so that you can then, with that rest of your dollars, spend, invest more aggressively, annuitize, turn into a pension because you know that you have those goals covered. That's the mindset. And I think not no one, but very few people are unsophisticated advisors in the accumulation phase. They just frankly don't understand it. It's not that they're giving bad advice on purpose. They just don't understand that back end of the planning. It's all a calculator to get to some higher number. And money isn't math. Money is a lot about emotion.
Oh, it's so much emotion.
And how you're feeling at the time.
Right. And I always say, like, life doesn't exist on a spreadsheet, right? It's like the buy term invest the difference idea may work on a spreadsheet, may look sexier on the spreadsheet, but life doesn't exist there. And one of the things that you, we talked about this, I think, on our last video, I think it is worth bringing up again. And for people who are just maybe seeing this for the first time, now I've been saying this, and I know you've been saying it, I want you to, touch on it, is why is now the best time in, generations to buy whole life insurance?
Why it's so good is the last time it was this good was the 1940s. So I did a lot of historical research on interest rates and how that flows through to the dividend and how these policies are constructed economically. And when I say that, it's really not, it's the best time in over 80 years to own it relative to what else you can do with your safe stuff.
Sure.
Again, cash, money markets, bonds, things like that. And the reason I say that is because we're coming off the biggest bull market in bonds ever. And bonds are math. It's not like we can we can collectively vote up the shares of Tesla and believe they're going to take over the world. Like that's just market pricing, us agreeing it costs that much. It's like art, that kind of thing. Bonds are math. It's like, what is the duration of the bond and what is the interest rate? So with a calculator, you can figure out the value. So why I say that is, we're coming off of a historically low interest rate environment. which is at the tail end of the biggest bull market in bonds we've ever seen, because rates basically fell for 40 years straight from 81 to 21.
Yep.
Which produced outsized returns in bond. It was the perfect diversifier for equities.
Totally.
And frankly, that was during the period of time that the entire financial planning industry, as we know it, was born.
Was created.
Asset allocation models,
100%.
target date funds, all the things that we talk about, that was born during this period of time when bonds could do no wrong.
Yep.
But in my research, in the prior 40 years, as interest rates were rising, do you know bonds lost value 1 out of 3 years?
Seriously?
It was more volatile than
I did not know that.
It was more volatile than the historical stock market. So if rates are low if the rates hover around here for the next 30 years, whole life insurance policies should do better, because these insurance companies are investing in longer durations than an individual typically can.
Yep.
Therefore grabbing more yield, which will eventually flow through the dividend. But in a rising interest rate environment, not only are bonds going to suffer from a rate of return standpoint, but there's going to be a lot of volatility. Losing money every few years, and people aren't used to that. They think of bonds as the safe stuff.
Yeah.
So a lot of people think that I'm a bond hater. I think everyone should just about everyone should own bonds. It's a diversifier. Sure. It's an asset class just like any other. Our job is not to pick asset classes.
Totally.
But if we need to have safe stuff in the portfolio, wouldn't you want it in something that must go up in value every single year? The only question is how fast. And that question is simply the rate of the dividend that will be paid from companies that have been paying dividends since Civil War times.
Totally.
Who are the strongest financial institutions in the country. It just doesn't make sense to me to think otherwise, now that I know what I know, but I know most people haven't done that work.
So can you explain a little deeper why to everybody, like when you put your money in a whole life contract and basically how the insurance company uses that and how you're effectively buying a bond, because that's what the insurance companies are investing in?
Yeah, I'm careful with my language, because you're not really buying a bond. You're buying an insurance policy.
Yeah, of course. Yeah.
If you understand the general investment account, the number one holding in all of the major mutuals is bonds. And it's not like government treasuries. It's long-term AAA rated corporate bonds from hundreds and hundreds of the biggest, safest corporations around the globe, highly diversified. So if you think about that general investment account, some of them also own equities, like wholly owned subsidiaries.
Sure.
Kind of like if you own Apple stock, you get your quarterly dividend.
Yep.
Same thing there. They own subsidiaries, and they pay dividends to the mothership, the mutual holding company.
They'll have real estate. They'll have other holding assets as well.
But by and large, it's fixed income. So the purpose of that fixed income is to generate return or generate cash flow.
Sure.
And when a company says they're paying a 5 or 6% dividend interest rate, they're telling you they're getting 5 or 6% cash flow that they're comfortable paying through to the policy owner. They're not selling assets in the portfolio to raise capital to pay a dividend. They're just passing through effectively what they're earning. So that's when we make statements like you're going to get bond-like returns. I'm not saying you're going to get exactly the same thing, but if those economics stay the same and those corporate structures stay the same, that will eventually flow through to you.
Right.
These mutual companies operate for the benefit of their policy owners. There's no shareholders pulling profits off the top.
For sure. And at the end of the day, because, I mean, what percentage would you say the average mutual insurance company has from a percentage perspective as a percentage of the total general fund in AAA rated bonds?
Depends on the company. Anywhere from just over half for some companies all the way to almost 100% for others.
Okay.
So, there are some companies that have some pretty big subsidiaries, which becomes a big piece of the pie. But there's other carriers that are just almost pure fixed income.
Really?
Which is fine. It's very safe, conservative. So I always say, if you can get bond-like returns over time, and to be clear, I'm not talking about 10 years. I mean, we're talking about 20, 30-year duration.
30 years, yeah.
Which is the planning horizon that people should be talking about. Over long periods of time, generations, if you're going to get bond-like returns, but the insurance company, through the whole life insurance contract, and only whole life, not VUL, not IUL, none of these other universal life contracts, actually guarantees that your cash values must rise, they've effectively given you a better risk-adjusted return on that asset. They're giving you a bond-like return, but none of the volatility.
None of that, and that's the key, right? Because you're going to get the bond-like returns, but on the negative years, the insurance company is carrying that weight for you, right? Like, and you can't overstate the importance of that when you hit retirement and you need access to that money.
Exactly. Yeah.
Right. I mean, that is one of the most powerful elements of planning. And when you say we're looking at 30 years, the thing is like, I know a lot of people are looking at this and maybe they're 55, 60. I get a lot of people in the 50 to 65 range that reach out to, and they're like, is this still good for me? What is your take on, a 55 to 65-year-old who's like, all right, and let's assume they're well saved and, in a decent financial position, but now they're curious or interested in how to integrate whole life insurance as part of this strategy for them.
Yeah.
What's your talk to, generically, not obviously, this is not specific advice. It's just kind of philosophically.
A couple ways to think about it philosophically is, to that client, congratulations, you've done well. You've got your portfolio, you've got your savings, you got your emergency fund. The problem is, you were exposed to some taxes and you're exposed to risk. And even if you're in, little cash, that's exposed to inflation risk. You're not getting a whole lot of yield on that. So nothing we can do about that. That's where you are today. And life insurance has amazing advantages, but if there is a catch, it takes some time. There's two catches. You got to be healthy enough to get it.
Sure.
The other catch is patience. You got to be able to build into this for 5 or 10 years. So I would propose to that person, if we're just thinking about it from a cash value standpoint, and the death benefit, should always be part of the conversation, is all we're going to do is for the next 10 years or less, if we want to be aggressive with it, we're just going to take your pile of cash and move it to this pile of cash, which at the end of the day will be income tax-free, guaranteed to grow every single year, and have a tax-free death benefit that gets paid out at the end of the day. I find at that age range too, is once they know they're wealthy enough, it starts to turn into a game. How do we lessen taxes?
100%.
And whole life insurance is a wonderful way to manage dollars out of qualified taxable accounts into something that's never taxed again. Just Google Roth conversion. That's effectively what you're doing, is you're converting taxable assets into tax-free assets. Same thing with whole life. If you take money out of an IRA, you pay taxes, you put it into a whole life plan, you'll never pay taxes on those again. So there's two conversations. It's the, I think, kind of myopically short-term focused conversation of cash value. But if your clients are thinking a little bit bigger, that crowd actually tends to focus more on death benefit. And knowing that my kids are going to receive that legacy. The rest is mine.
All right, last question for you as we go here. So one of the things that I hear on social media a lot from the buy term and invest the difference people is like, all right, it's almost like they say that whole life, they've conceded, right? Because I tell them all this stuff, and I was doing this on a live, and I got them to the place where like, oh my gosh, that's so good, you're right, and that works for the wealthy people. But I'm dealing with the lower, like younger, less affluent people. Whole life doesn't work for them. What's your take on whole life for more middle class, not well saved, maybe the 30 to 35-year-old? And by the way, for the record, before I have them answer this, I'm a huge fan of term insurance in these situations, but I also love whole life as a savings vehicle. But what's your take on, what would be your response to somebody that says whole life just doesn't ever work for somebody who's 30 years old, middle class, making 60 grand a year, whatever?
It will, though.
It will.
If you have a client that is earning income on an increasing basis and saving and forward thinking enough to be talking to an advisor in their 30s, they're going to have real wealth down the road. First and foremost, they should buy enough coverage to make sure their family's taken
100%.
And it's not $500,000. It's millions.
Probably 2 million, 3 million for.
I don't know many people that need less than $1 million these days. I mean, it's real numbers. So get that first. But I would say get it from one of those big mutual whole life carriers, dividend paying carriers, even if the term insurance is a little bit more expensive. Because someday will come down the road when you get promoted from that $60,000 job to the $120,000 job. And now there's an opportunity to convert into something that can last a lifetime. And you only can do that with a handful of companies in a really good, meaningful way. Most carriers have some conversion option, but frankly, it's not anything I'd ever want. You want it from one of those big carriers, and that's why they put you through the ringer a little bit up front. But there's always value in that. So that's my response. There's never a level of wealth or age where it doesn't make sense. Getting enough coverage first is first and foremost, because if you got a young family without a lot of money and you got kids, first and foremost. But there will come a day. People don't see it yet, but there will come a day when you're going to want to diversify those assets and you're going to want to move into a little bit bigger picture thinking. And that's where whole life fits. So whether you can afford it today or not, doesn't matter.
But it's a blend, just to be clear. Like, to me, most clients that we have come through, we're doing 2 policies on every client. A blended whole life policy and then a term policy to make sure that their insurability is maxed out.
It's not either or. It's you can have both for sure.
Yeah, no, that's awesome, man. So anything else that you'd like to cover? I think that was a lot. That was pretty good.
That was a lot. Any other questions you have for me?
Not at this moment. Maybe tomorrow we'll do another video. But guys, I'll say this before we end, is get his book. And And I think a lot of this is covered in your book, right? It goes pretty deep, and it's one of the most impactful books if you're curious about how to utilize life insurance as an asset, because like you said, it's an asset, right? And just if you really want to understand the depths of whole life insurance as an asset, his book Permission to Spend is one of the best books that will like really, really break it down succinctly for you. And so I'll put the link in the description below for you to go check it. Do you have a website, or is it on Amazon, or like where's the best place to buy it?
It's on Amazon or permissiontospend.com. And on permissiontospend.com, you can order in bulk, which is really what who I wrote it for. It's written for a client.
Okay.
And my goal in writing it was so that advisors would give it to their clients, because I think there's so little positive third-party material out there from someone relatively objective about this stuff.
For sure.
So it's very research-driven. A lot of that research is in the book, but high enough level where a client can get through it.
Okay.
And I have a lot of advisors, passing it out to their clients all throughout the year.
Yep.
As just kind of backup for the conversation, but to get them thinking a little bit differently about where it fits. And I've heard of some very big sales coming from those books going out to clients.
Yeah, I've experienced those big sales. So that's awesome. So I would say if you're an agent, go to permissiontospend.com and look at the bulk option. You may want to take advantage of that. If you're a client who's watching this, or somebody who's thinking about utilizing whole life insurance, maybe just either go there, go to Amazon, check it out. Put all of his social media links down in the description below as well. Really excited, man. Stoked to see you again.
Great to see you, man.
And that's it. So if you haven't already, make sure you're subscribing at the bell. That way you're notified every time we launch a new video. And we'll see you on the next one. Later.